Goldman Sachs, Morgan Stanley, JPMorgan. The most powerful financial institutions on the face of this planet, the same institutions that manage trillions of your retirement dollars, and they all agreed on something. The S&P 500 is going higher. Again. Now before you roll your eyes and say, yeah, they always say that. What if I told you that even the most courteous voice on Wall Street, Bank of America, is calling for a 7,100 target on the S&P 500 this year? And Morgan Stanley, they're calling 7,800. Deutsche Bank, 8,000. If that happens, that's a 14 to 16% gain on top of the 17% the market already handed investors last year. We are talking about a stock market that has literally doubled since 2020. But here's what nobody on CNBC is telling you. These banks don't all agree on how the gains come, who benefits, which sectors win, and most critically, what could blow the whole thing up. And that's exactly what we're going to decode today. Wall Street's 2026 predictions, the next big market moves. This is Wall Street's full 2026 playbook decoded, simplified, and translated into moves you can actually make with your money. Stay with me, because by the end of this video, you are going to understand this market at a level that most people who've been investing for 20 years never reach. Let's go. The biggest banks on earth just published their 2026 predictions. 100-page reports, billions of dollars of research, armies of PhDs. But here's the thing about those reports. They bury the important stuff. Today, I'm pulling it out, the predictions, the opportunities, and the risks they hide in the footnotes. Because the investors who read the footnotes, they're the ones who actually build wealth. 2. The battlefield understanding, where we are. Before we talk about where this market is going, we need to understand where it's been. Because context is everything in investing. S&P 500 annual returns 2020 to 2025. 1. A global pandemic shuts down civilization. The stock market crashes 34% in 33 days. And then, like something out of a fever dream, it came back. Not just back. It gained 18% for the year. 2. 29% returns. People quit their jobs. Reddit forums became trading desks. Everyone was a genius. 3. Reality check. The market dropped 18%. Inflation surged to 40-year highs. The Fed started hiking rates at the fastest pace since the 1980s. Portfolios got crushed. A lot of those genius investors quietly went back to their day jobs. 4. The comeback nobody predicted. 25% returns. Driven almost entirely by a handful of companies that most people couldn't even explain the business model of a year before. 5. 20%. Again. 6. 17%. Despite tariff chaos. Despite AI bubble scares. Despite everything the talking heads said would derail it. Let that sink in. In 6 years, the S&P 500 has doubled. If you had $50,000 in a simple S&P 500 index fund in January 2020, and you did absolutely nothing, no market timing, no panic selling, no genius stock picks, you would have over $100,000 today. That is the power of this market. That is the power of staying in the game. But now Wall Street is telling us 2026 is going to look different. Not worse. Different. And the details of that difference are what will separate the investors who build wealth from the investors who just watch it happen to other people. So which camp are you going to be in? Because by the end of this video, that answer is going to be a whole lot clearer. 3. What Wall Street is actually saying. Every year, the biggest banks on Wall Street spend millions of dollars producing research reports on where the market is headed. We're talking 100-page documents. Dense, technical. Written in language designed to confuse you. I read them so you don't have to. Here's what each institution is actually calling for in 2026. JPMorgan double-digit gains. JPMorgan, one of the most powerful financial institutions on earth, managing assets worth more than the entire GDP of most countries. Their call for 2026? double-digit gains across global stocks, both developed markets and emerging markets. Their argument is built on three pillars. The AI investment cycle is accelerating, not slowing. Corporate earnings are growing at 13 to 15% above trend. And lower interest rates are giving companies cheaper access to capital, which fuels more investment and more growth. But here's the catch buried quietly in JPMorgan's outlook. They're also forecasting a 35% probability of a US recession in 2026. 35%. That is not a footnote. That is not a minor caveat. In a coin flip, 35% means losing more than one in every 3 times. Morgan is bullish and scared at the exact same time. And that tension, that's the most important thing you can understand about where we are in this market cycle. Morgan Stanley S&P 7,800. Morgan Stanley is calling the S&P 500 to hit 7,800 by year-end. That's roughly a 14% gain from where we started 2026. Their thesis rests on 3 legs. Federal Reserve rate cuts lowering the cost of borrowing, corporate tax cuts boosting after-tax earnings, and AI efficiency gains spreading across the entire economy, not just tech companies, but healthcare, logistics, manufacturing. They expect volatility along the way. They're not pretending the ride will be smooth. But their core conviction is simple. US corporate earnings are growing, and this bull market still has legs. Goldman Sachs' small caps moment has arrived. Now here is where it gets genuinely interesting. Goldman Sachs, and this surprised me when I first read it, is making a bold case for small cap stocks to outperform in 2026. Think about what that means. For the last several years, the market's gains were concentrated in a handful of companies. 7, to be specific. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. The Magnificent 7. That's where the money flowed. That's where the returns were. Goldman is now saying 2026 could be the year the rest of the market catches up. And their historical data backs it. After the end of previous Federal Reserve rate cutting cycles, small cap stocks have historically outperformed the S&P 500 by an average of 12%. 12%, on top of whatever the broader market does. If Goldman is right and small caps run this as a generational entry point that most retail investors will completely miss because they're still fixated on Nvidia's stock price. Bank of America is the measured voice in the room, and I respect them for it. Their head of U.S. equity strategy expects S&P 500 earnings to grow 14% in 2026. But she only projects the index itself to rise 4 to 5%, with a year-end target of 7,100. The disconnect she sees. We're shifting from a market driven by consumer spending to a market driven by capital expenditure. Companies are investing massively in AI, infrastructure, and energy. That kind of investment doesn't show up as stock price gains immediately. It shows up years later. Bank of America is essentially saying, the fundamentals are strong, but don't expect the stock market to immediately reflect that. The returns are coming, they're just being reinvested before you can see them. So what's the one thread connecting every single one of these forecasts? What does JPMorgan's AI supercycle, Goldman's small cap call, Morgan Stanley's rate cut thesis, and Bank of America's capital expenditure warning all have in common? One word: AI. And that leads us to the 3 forces that are going to define your portfolio in 2026. 4. The 3 forces defining 2026. I want to walk you through what I call the 3 forces of 2026. These are the macro tidal waves that will lift or crush sectors, stocks, and ultimately your net worth over the next 12 months. Let's break each one down. Force number 1. The AI superior CECLE. 4C. 1. The AI superior CECLE, the money printer, that WONTSTOP. JP Morgan calls it the AI supercycle. Goldman calls it tectonic, a tectonic broadening of the bull market. Whatever name you give it, here's the hard truth. AI spending is not slowing down. It is accelerating. The companies building AI, Microsoft, Nvidia, Google, Amazon are spending hundreds of billions of dollars on data centers, chips, and cloud infrastructure. And that capital doesn't stay in tech. It ripples through the entire economy. Who builds those data centers? Construction companies. Who powers them? Energy companies. Who makes the networking equipment? Industrial manufacturers. Who provides the financing? Banks. JPMorgan estimates that AI-driven capital spending is fueling above-trend earnings growth of 13 to 15% across a wide range of industries. Not just tech. That is the multiplier effect of the AI supercycle. And here's the uncomfortable reality. Most people are thinking about AI as a stock market story. Goldman Sachs is telling us it's an economic story, a fundamental reshaping of how companies generate profit. Goldman's own analysts are calling 2026 the beginning of a broadening bull market. The gains that were locked inside 7 mega-cap companies in 2023 and 2024 are starting to spill over into the wider economy. A rising tide that lifts more boats if you're positioned to catch it. Force number 2, the Fed's next move. Force 2, what the Federal Reserve does next and why it matters more than you think. Here's what most people don't understand about interest rates. When rates go down, money gets cheaper. Companies borrow more, invest more, hire more. Earnings grow. Stock prices rise. When rates go up, the opposite happens. Money gets expensive. Companies slow down. Earnings get squeezed. Stock prices fall. For 2 years, the Fed was hiking rates to fight inflation. That crushed a lot of investors. 2022 was a brutal reminder of what tight money does to portfolios. But in 2024, the Fed pivoted. They started cutting. And Wall Street's entire 2026 bullish thesis is built on the assumption that the Fed cuts by another 50 basis points this year. Goldman Sachs, Morgan Stanley JPMorgan, they all see it coming. Cheaper money, lower borrowing costs, expanding profit margins, rising stock prices. But here's the nuance that separates intelligent investors from reactive ones. The Fed doesn't cut rates because things are going well. The Fed cuts rates because they're worried the economy is slowing down. So when the Fed cuts, yes, the cheaper money is good for stocks on paper. But the reason behind the cut matters enormously. JP Morgan's 35% recession call. That's the scenario where the Fed is cutting because the economy is genuinely weakening. In that environment, cheaper money helps, but it doesn't fully offset the damage. This is the razor's edge Wall Street is walking in 2026. And it's the reason why understanding the why behind predictions matters just as much as the predictions themselves. Force number 3, the dollar's decline. Force 3, the weakening dollar, the quiet force reshaping to global real estate. Goldman Sachs has a clear, explicit call on the US dollar in 2026. It's going down. As US interest rates fall and fiscal spending remains elevated, Goldman expects demand for US assets to diminish and with it, demand for dollars. Now, why does this matter to you personally? A weaker dollar is a gift to multinational corporations. The revenue that Apple earns in Europe, that Microsoft earns in Asia, that Amazon earns globally when those revenues are converted back into dollars. A weaker dollar means more dollars come home. Earnings go up without selling a single extra product. A weaker dollar is also a massive tailwind for emerging markets. Countries like India, Brazil, Vietnam, and Southeast Asia become more competitive. Commodities priced in dollars become cheaper in local currencies, boosting demand. Goldman Sachs is forecasting China's economy to grow 4.8% in 2026. Global growth at 2.8% outperforming the broader consensus. Here's the direct implication for your money. If you are only invested in the United States, you may be leaving significant returns on the table in 2026. International diversification isn't glamorous. It doesn't generate headlines. But in a year where the dollar weakens, global growth holds, and AI investment ripples, globally the investors with exposure beyond US borders could capture gains that the domestic-only crowd completely misses. By the way, if you've made it this far into this video, you're already doing something that the overwhelming majority of people will never do. You're investing in your financial education. and I genuinely believe it is the highest returning investment you will ever make. If this breakdown is giving you clarity, hit that subscribe button, because this channel exists to give you the financial knowledge that actually changes the trajectory of your life. Now let's keep going, because we're about to get specific. 5. The 60 hours, where Wall Street is actually putting its money. Follow the money. Predictions are interesting, but I don't want you to leave this video and just nod along. I want you to know where to look. So let's talk about the specific sectors Wall Street is actually betting on and the logic behind each one. Sector number 1. Technology AI buyers beyond the obvious. Technology, but not the play you're thinking of. Yes, Nvidia has been the poster child of the AI trade. Yes, Microsoft and Google are still dominant. But Goldman Sachs' call for 2026 is actually about the companies that enable AI, rather than the companies that simply brand themselves as AI. The chip equipment manufacturers that make the machines that make the chips. The cloud infrastructure providers that host the models. The cybersecurity companies protecting all those AI systems from increasingly sophisticated attacks. Goldman's analysts are calling it tectonic, a tectonic shift in what the money flows within the technology sector. Not just to the giants, but to the enablers, the suppliers, and the infrastructure layers that the giants depend on. Sector number 2. Financials, the overlooked winner. Financials. Banks. Asset managers. Insurance companies. This is the sector flying under the radar in most retail investor conversations. And that's exactly where opportunity lives. When the bull market broadens, when more companies go public, more deals get done. More mergers and acquisitions happen. Investment banks generate enormous fee revenue. Global investment banking revenues already topped $100 billion in 2025. And analysts expect that number to grow in 2026 as deal-making activity accelerates under a more business-friendly regulatory environment. Wall Street is essentially betting that the people running Wall Street are about to have a very profitable year. There's a certain poetry in that. Sector number 3. Small caps, the highest conviction beat. Small caps. Goldman's boldest call. And once you understand the mechanism, it's actually not as risky as it sounds. Small cap companies, the Russell 2000, companies with market capitalizations between $300 million and $2 billion carry significantly more floating rate debt than large cap companies. What that means in plain English, when interest rates fall, their interest payments go down. Immediately, their margins expand, earnings grow, and the stock price reflects that. Goldman's historical analysis shows small caps outperforming the S&P 500 by an average of 12% following the end of Fed rate cutting cycles. We may be sitting at exactly that inflection point right now. And here's the brutal truth. Most retail investors are going to miss this entirely because they're locked into the same 7 stocks they've been watching for the last 3 years. Sector number 4. Energy, the foundation of the digital economy. Energy. Specifically, the energy needed to power the AI revolution. This is the connection most people are completely missing. Data centers consume staggering amounts of electricity. The AI supercycle is simultaneously a power supercycle. Every AI model trained, every query answered, every image generated requires massive amounts of energy. Goldman Sachs' commodity team is calling 2026 the year of the power race. The geopolitical competition between the US and China to dominate AI is also a competition to control energy resources. Nuclear, natural gas, grid infrastructure. These are quietly becoming the most strategically important assets in the global economy. This is not your grandfather's energy trade. This is the literal foundation of the digital economy being built in real time, and most investors aren't paying attention. 6. The RIS case, what are already not saying out loud. Now, let's talk about what could go wrong. Because if you build a financial strategy that only plans for the upside, the market has a way of reminding you, very painfully, that it doesn't care about your plan. Risk number 1. The AI bubble. Risk number 1. The AI BBL that nobody wants to eliminate exists. Let me say something that's going to make some people uncomfortable. Not every AI company is going to survive. Not every AI investment thesis is going to pay off. History has a very specific warning for us here. 1. The dot-com boom. Every company with "com" in the name was worth $1 billion. Venture capital was pouring in. Everyone was getting rich. Until the market figured out that most of these companies had no real revenue, no real business model, and no path to profitability. And when it figured that out, trillions of dollars in wealth disappeared in months. The Guardian recently described AI as potentially the biggest speculative mania of the 21st century. That might be hyperbole, but the warning embedded in it is legitimate. The AI companies that will win, that will still be standing 10 years from now, are the ones solving real problems, generating real revenue, and showing real returns on their AI investments. Many companies currently calling themselves AI companies are doing none of those three things. When the market separates the real from the hype, and it always does, the separation is going to be sudden, sharp, and brutal. Risk number 2. Inflation that will die. Risk 2. CICQ the inflation, the geost that won to leave. The Fed's entire 2026 rate cutting plan depends on one assumption: that inflation continues falling toward the 2% target. But what if it doesn't? JPMorgan specifically flags sticky inflation as a prevailing theme for 2026. If inflation remains elevated and the Fed can't cut rates as aggressively as the market has already priced in, the entire bullish thesis starts to crack. Mortgage rates stay high. Consumers feel squeezed. Corporate borrowing costs remain elevated. Earnings miss estimates. And here's the most dangerous part of that scenario. The market has already priced in those rate cuts. If they don't arrive on schedule, the repricing when investors realize this could be sharp, fast, and emotionally devastating for unprepared portfolios. Risk number 3. Geopolitical wildcards. Risk 3. The wildcards nobody can deal. This is the one nobody can assign a number to with any real confidence. Trade wars, tariff escalation, military conflicts, political instability in major economies. 2025 already demonstrated how fast a tariff announcement can send markets into a violent tailspin. Trillions of dollars in market cap wiped out in days, not because earnings changed, but because sentiment shifted overnight. Morgan Stanley specifically calls political risks the most significant looming threat over their otherwise bullish 2026 outlook. Markets hate uncertainty, and right now uncertainty is the only thing in guaranteed abundance. Risk number 4. Market concentration, the hidden fragility. Risk 4. Your diversified portfolio may not be as diversified as you think. Here's a math problem that should genuinely unsettle you. The S&P 500 has 500 companies in it. It sounds diversified by definition. 500 companies. But in recent years, the top 7 stocks, the Magnificent Seven, have accounted for a disproportionate share of the index's total returns. A significant chunk of every dollar in diversified index funds is concentrated in just 7 companies. What that means practically: if those 7 companies have a bad year for any reason, earnings miss, regulatory action, geopolitical exposure, AI disappointment, the entire index feels that pain. Goldman Sachs is betting on a broadening. But JPMorgan and Morgan Stanley both explicitly acknowledge that if that broadening doesn't materialize, if medicap tech continues to dominate, the concentration risk remains a ticking clock at the center of the most widely held investment vehicles in America. This is not pessimism. This is precision. The investors who survive market downturns don't survive because they predicted them. They survive because they built portfolios that could withstand them. There is a difference between paranoia and preparation, and the difference is your net worth. 7. Your 2026 wealth bigo K5 moves that matter. Alright. You now know more about the 2026 market outlook, than most people will ever know, including a significant percentage of people who call themselves investors. But knowledge without action is just expensive entertainment. So let me leave you with your actual playbook. 5 moves. Specific, actionable, built on the same data that Wall Street's best analysts are working from. Move number 1. Your index fund is still your foundation. Move 1. Don't abandon what works. Whether the S&P 500 hits 7,100 like Bank of America thinks or 8,000 like Deutsche Bank is calling, a low-cost S&P 500 index fund remains the single most reliable wealth-building tool available to the average investor. Remember the rule of 72. At the market's historical average return of approximately 10% per year, your money doubles every 7.2 years. Don't let the predictions pull you away from the system that has worked for generations. Don't let the noise make you sophisticated in the wrong direction. Move number 2. At least a look at small caps. Move 2. Goldman's call deserves your attention. You don't have to bet the farm. But if Goldman Sachs, one of the smartest institutions in the history of finance, is making a historical case for small caps to outperform in a falling rate environment, that deserves at least a conversation with yourself. A 10 to 15% allocation to a broad small cap ETF as a complement to your index fund in a year where the Fed is cutting and AI gains are broadening is a historically defensible position. Don't ignore it because it's not the headline trade. Move number 3. Know what you actually own. Move 3. Open your portfolio right now and look. Go check your index fund's top 10 holdings. Look at what percentage of your diversified portfolio is actually concentrated in the top 7 companies. If more than 30% of what you own is sitting in 7 stocks, you are more concentrated than you believe. That's not automatically wrong, but you should know it. Because if the Magnificent 7 stumble, and all things in markets are cyclical, they always rotate. You want to understand what that means for your specific situation. Not in theory, in dollars. Move number 4. Build for resilience, not just returns. Move 4. Build a portfolio that doesn't require you to be right. JPMorgan sees a 35% recession probability. Goldman sees expansion. Morgan Stanley sees volatility regardless. Deutsche Bank sees 8,000 on the S&P. They cannot all be right. And you don't know which one will be. Neither do I. Neither does anyone. So build a portfolio that doesn't require you to win the prediction game. Genuine diversification across stocks, bonds, real assets, and international exposure is not exciting. It will never go viral. It won't make you sound smart at a dinner party. But it is the strategy that keeps you in the game when the unexpected arrives. And in markets, the unexpected always arrives. The investors who build real wealth aren't the ones who made the right call in 2026. They're the ones who were still in the game in 2030, 2035, and 2040. Because they never got wiped out by overconfidence in any single prediction. Move number 5. The highest return investment you will ever make. Move 5. Invest in your financial education relentlessly. I'll say it plainly, and I'll say it without apology. The investor who understands compounding, who knows the rule of 72, who understands what drives market cycles, who can read between the lines of a Wall Street forecast, that investor will outperform the one who doesn't. Not because they always pick the right stocks, but because they never panic sell at the bottom. They never chase hype at the top. They stay in the game long enough for compounding to work its irreversible mathematical magic. The 8-4-3 rule tells us something profound. With consistent 12% annual returns, the kind the S&P 500 has delivered historically over the long run, your money doesn't just double. In 6 years you've doubled. In 12 years you've quadrupled. In 18 years you've grown eightfold. Eightfold. Not because you're smarter than Wall Street. Not because you called the 2026 market correctly, but because you understood the engine and you kept it running. 18 years of patience is not a sacrifice. It's a strategy. And it's one that has made more ordinary people wealthy than every stock tip, every prediction, and every CNBC headline in history combined. Wall Street has laid their cards on the table. Goldman Sachs, Morgan Stanley, JPMorgan, Bank of America, the most powerful financial minds on earth, have shown you their hand for 2026. You now understand the three forces. You know the sectors. You see the risks hiding in the footnotes. And you have 5 concrete moves to make this information work for your wealth. The only question remaining is, what are you going to do with it? If this video gave you real value today, and I genuinely believe it did, here's what I need you to do right now. Hit that subscribe button, because this channel exists for one purpose: to give you the financial knowledge that doesn't just inform you, it transforms the trajectory of your life. Drop a comment below. Which prediction surprised you the most? Is Goldman right about small caps? Is JP Morgan's 35% recession probability keeping you up at night? Tell me where your head is at. I read every single comment. Let's talk. And if you want to go even deeper, the video right here breaks down exactly how the mathematics of compounding works and why starting today, at whatever amount you have, is the most powerful financial decision you will ever make. Don't wait for the perfect market moment. There is no perfect market moment. There's only the one you're in right now. I'll see you in the next one.